This is not financial advice. I'm recording my thoughts about Uipath, which is a robotic process automation company. I've done a few videos about Uipath in the past, so you can check them out on my channel. Stock has dropped about 8% today and it is currently trading at about $15 with a market cap of about $9 billion. So I have to decide whether to buy this stock at this price or not. Let's first look at some numbers and then I'm going to do the valuation of Uipath. In the most recent quarter, their revenue grew by about 18% year over year. And their dollar-based net retention rate is about 122%, which is great. GAAP gross margin is about 85%, which is phenomenal. And then they have about $1.8 billion of cash and cash equivalents. The full fiscal year of 2024, they're saying that they can achieve anywhere between $1.26 billion to about $1.27 billion of revenue. This represents about 20% growth year on year. But during the pandemic, in 2020, they grew their revenue by about 80%, and in 2021, they grew their revenue by about 47%. And all of a sudden, the growth is about 20%, and therefore the stock dropped significantly in the past year. Let's quickly look at their stock dilution. This company has $1.3 billion of cash and cash equivalents, but still they are diluting the shareholders significantly. If you look at my screen, they had about 542 million outstanding shares in 2022, and in 2023, in the 3 months ending, they have about 558 million outstanding shares. That's about 2.7% dilution. Let's move on to the valuation. I'm going to provide two cases, one with reasonable assumptions and the other with great execution. In the reasonable valuation, in 2022, they made about $1.05 billion of revenue. In the most recent year, they're saying they can achieve about 20% growth rate, right? So I'm assuming 15% growth rate year on year for the next 5 years. Remember that as the company gets bigger, it's hard to grow. That's why I'm assuming 15%. With that, they can make about $2.11 billion of revenue in 2027. This company's gross margins are in the order of 85%, so they can definitely achieve about 30% net profit margin. With 30% net profit margin, they can make about $630 million of net income in 2027. A company that's growing in the 15% range and has a net profit margin of 30%, I can assign a multiple of 22.5, but I'm going to give a premium multiple of 25 for this company, with which this company would be worth about $15.8 billion in 2027. As I said before, this company has about 558 million outstanding shares and they are consistently diluting the shareholders. In the most recent year, they diluted us by about 2.7%. So I'm assuming 2% dilution for the next few years, with which this company will have about 616 million outstanding shares in 2027. When I divide the market cap with the number of outstanding shares, I get about $26 stock price in 2027. Currently, it's at $15, right? So that's about 71% gain. On to the great execution case, I'm going to assume revenue growth rate of 20% year on year for the next 5 years. I keep the net profit margin as 30%, same as the base case. I'm assuming a multiple of 27.5, with which this company would be worth about $21 billion in 2027, and the stock price would be about $35. Currently, it's at $15, right? So that's about 133% gain in 5 years, which is a good gain. If we believe in the base case, the gain is about 70%, and if we believe in the great execution case, it's about 133%. For me, in the base case, I'm getting a 70% gain, but with a lot of execution risk. I don't know whether they can grow at 15% year on year or not. So I'm neutral at this point. I don't think it's a terrible buy if someone wants to buy at $15, but for my personal journey, I'm going to stay away from this stock, and I'll think about it if it gets to $12 range. In that case, in the base case, I can at least get a 2x, right? So those are my thoughts. Please provide any feedback. Thank you so much for watching.